Hello, everybody. I am Rama Trades. Welcome to our Trading Essentials course. And this is a very basic course. So, if you don't know anything about trading, you are in the right place. We're going to go ahead and jump straight into it. By the end of this, if you have any questions, feel free to actually message me in our questions channel on our Discord, and I'll get back to you as soon as possible. You can take a screenshot of your chart or whatever it is to help me understand your question, and I'll try to get back to you as soon as possible. Here's the main goals for today. We are going to go through 7 different areas, well, mainly 6 different areas, and then we'll be done with the course, which will be great. Why am I doing this? We'll start there. Why am I doing this? Well, I started trading in 2018, and when I first started trading, I would pay for courses, go onto YouTube, and I started to realize that there's just so much content out there. You don't really know where to start. And I also started to realize I would spend thousands of dollars on courses only to realize that the person that is actually running these courses are just trying to figure out ways to make money out of me. So they wouldn't give me, it wouldn't be the best course ever. They'd end up, I'd do this course and then they would try to sell me on something different. I'd go to YouTube. There'd be so many different videos. I wouldn't even know where to start. I wouldn't know who was being honest with me, really the main things I should be actually focusing on. And so I would just kind of leave more confused than actually feeling like I'm actually learning something. And so I wanted to create a course and a community that can just do this together. Whether you're beginning, whether you're an advanced trader, we're here to do this together. The markets can be very unforgiving. And so we got to be able to build a community of people that can strengthen each other, sharpen each other, which is amazing. And I don't really have an agenda. My goal is just to create a course and a community that can thrive together. And I do want to encourage you. We don't have any overheads right now, so we don't have. I'm editing. I don't have an editor. I'm doing all this out of my own pocket, and our goal is to keep this Discord free for as long as possible. So I want to encourage you, take advantage of this. Like, get involved in the Discord, start asking questions, and hopefully we can do this together, grow together in and through this, which would be amazing. But we're gonna jump straight in. So we're gonna tackle firstly trader psychology. These are the 3 areas that we're gonna kind of cover. Now, like I said, this is basics. We could spend 3 days just talking about trader psychology, but I want to encourage you. This in itself, trader psychology, it might be really boring. The things I'm going to talk about for this period that we have together, but I want to encourage you. This is probably some of the most important things is your psychology. So make sure you're taking notes. And if this is something that you can't really wrap your head around, uh, trading probably isn't for you, unfortunately. And like I said, you're not paying me for this, so I can tell you straight. I'm not going to try to tell you what you want to hear so that you can keep paying me. I'm going to tell you what you need to hear so that you can be a successful trader. So we'll jump straight into it. Discipline and emotion. Emotional trading can spark fear, greed, and revenge. When you're trading, oftentimes people underestimate that it's not just a strategy that's going to make you successful. It's also your mentality. What if you get into a trade and you maybe have over leveraged and you place a trade, the trade starts going in the opposite direction, then you get fearful, then you start adding positions, and then you're before you know it, you're down even more money, and then you lose the trade, and then you have this revenge mentality, this revenge emotion going, I need to make this money back. So then you start trading trades that you don't want to trade, or maybe you start making money and then you start getting a bit greedy, you start risking more than you should. You got to understand that emotions are a big part of trading. um, and so until you understand that you need to stick to your rules, keep your emotions in check, that's when you're going to begin to see freedom in your trading. Common mental pitfalls is over trading, constantly trading 5 to 10 trades a day. Most successful traders trade 1 to 3 trades in a single day. Most traders that actually are successful and make real money trade less of the time than most traders that don't make money. Fear of missing out is watching a trade run in the direction that you thought it was going to go in, but you didn't get in. So you go ahead and place a trade too late. And before you know it, the trade starts reversing. Holding losing trades for too long. Have a stop loss and stick to it. Impatience, being impatient for results. Uh, it takes time. Trading is not a get rich quick scheme. If you think that is the case, this is not going to serve you well. You have to understand that trading is seeing results over time, compounding interest, compounding results. Um, Another mental pitfall is trading with money too early. Uh, if you don't have good psychology down, you don't have a good strategy, and you start trading with real money, you're going to be setting yourself up for failure. The transition from demo to a live account is also another mental pitfall. Is you might go to demo account and practice with fake money, and you're doing really well, and then you move on to real money. You don't realize that whenever you were trading demo, you were trading without real money, which meant that emotions aren't at play. But then when you move to a live account, emotions come into play, and you start realizing, oh, I'm losing more than I should. You have to really start scaling in slowly. Scale in very slowly. Here's a mindset of a successful trader. So that was of an unsuccessful trader. Here's a successful trader is understanding that you're about the process, not the outcome. Your focus is the process, not the outcome. Taking good trades, probability. No trade is guaranteed. Think long term. Understanding that every trade you get into does not mean you're going to win it. There's chances you're probably going to lose, but it's a long term game. Journals and learns from mistakes. Actually, actually writes down notes, learns how they can constantly improve. Trading is supposed to be boring. If you're not bored, you're probably not trading. You're probably gambling. Now that comes to another thing that we need to talk about. Is trading gambling? I would say it is not gambling. When you look at gambling, it is about intuition and hope. When it comes to trading, it's about a strategy. It's about a plan. It's about staying disciplined. Everything involves risk. When you come into your home, you're you're still risking your life to an extent. You're hoping and praying that when you walk into your home, your home is not going to collapse on you. There is risk to everything that we do, but there's calculated risk. With gambling, there's not really calculated risk. You walk into a casino and you look at roulette tables, and you might go, oh well, how many times has this table landed on red, how many times has this table landed on black, and you might make a decision based on that. But that is not necessarily a strategic decision or strategic plan. That is actually just kind of a hope and a prayer. With trading, you can actually study the market. You can actually educate yourself to get an edge when it comes to the market. It becomes gambling when you allow your emotions to rule you, when you allow hope to become the decision maker. Habits, stick to your plan. Manage expectations. There's no get rich quick scheme. You have to do this over time. Take your time and practice. Core concepts. We're going to jump straight into core concepts. Now, this is the heartbeat of this lesson. Now, everything's important, but this is going to be kind of the real meat where we're going to kind of really focus on in this session. What is trading? How the market works? Key terminologies. Reading a chart, risk management, and simple strategy examples. What is trading? Trading versus investing. Now, trading and investing are basically the same thing. There's little nuances to both, but when it comes to trading and investing, you are putting money into a market and you're basically hoping that's going to go up or down. Now, for the different types of markets, you have Forex, which is short for foreign exchange. Now, we're going to dive into that a little bit more. So I'm not going to answer what that is just yet. But we also have stocks, which is basically buying equity or shares within a company. Now, you would look and research basically what that company is up to, how they're tracking, how well they're doing, what the risk would be for investing into a stock or a company, and getting into that crypto. I like to call it the hype market, but we're not going to dive into crypto too much. Commodities is basically like your metals and different things like that. So like silver, gold. Different things like that. The goal of trading is buying low and selling high. Buying low and selling high. We're going to jump straight into different types of traders. We're going to go deeper into that. So there's certain types of traders called scalpers. Now that's pretty much what I am. Scalping is like sprinting. A scalper might enter and exit a trade within seconds or minutes and looks for smaller positions. So you're in and out within minutes. The only downfall with scalping is you tend to have to spend a little bit longer watching the charts for longer periods of time. Now you can shorten that based off your strategy and how you run your strategy, so that can change. But that's what a scalper is. We're going to move to intraday traders. Intraday trading is more like running a 5K. These traders open and close all the positions within the same day. So they could be in a trade for 1 to 5, 6 hours. They're just going to be out by the end of the day. Um, and then you have swing traders. Swing traders is like hiking a tall mountain. I would say not necessarily a tall mountain. I would say doing like a week long marathon. You're going to go hiking for a day, then you pitch a tent, sleep somewhere, then wake up in the morning, continue to hike. Like this is something you're going to be holding for a while. You could be holding trades for months. Um, the downfall of swing trading though is you might get in a trade, hold it for a couple of weeks, and it be in drawdown. Be negative for so long, and it might be negative for so long, and for weeks, and there might be other trade opportunities that come up that are even better, but you can't get into them because you're already in a trade potentially if you don't have enough capital to be able to get into another trade. And you might lose that trade and missed out on really good opportunities that come up. So that's the kind of the downfall of swing trade. Now there's ways around that, but there's pros and cons to each one. Um, Types of traders. So those were the types of traders based off of how long you're in and out of the market. These types of traders are based off your strategy. So how you kind of view the market. So you have technical traders, which is heavily what I am. I use charts and indicators and price patterns to make decisions. Now I don't really use indicators too much. I mainly trade price action. Um, I believe history repeats itself in the markets, and I'll explain that a little bit more later on. Um, Fundamental traders focus on news, economic data, and interest rates to predict the price moves. They think price is driven by real world events. Now, I do believe in both of these. I do believe that price is driven by real world events and technical, and I'm also I believe that price repeats itself. Now, I think if you can combine those two, it's a really powerful thing. Now, we're not going to dive too deep into these today, but I do think those are two great areas to look into. Sentiment trading looks at the market emotion and positioning, kind of looking at what the crowd is doing. You may use tools like a COT report or fear of greed indexes that do get released. It's just basically seeing, what the main people are doing. Now, a lot of people that trade crypto end up using things like these, kind of reading what the crowd is doing when it comes to getting in and out of crypto. Um, how the market works. Currency pairs versus which is base versus quote. Now we're going to jump straight into kind of charting, which would be good. So you have a base currency and you have a quote currency. The first currency in a pair is a base currency. The second currency in a pair is a quote currency. I'll show that to you now. So here we have the Euro USD. We're jumping into this is what we call foreign exchange or forex. So here you'll see we have the Euro USD, and on the euro is the base currency, so it's the first currency listed. The quote currency is the USD currency, and if you look here, €1. So if euro is the base, and €1 would equal 1.10 US dollars. So if you buy euro USD, you're buying the euro and selling the USD. If you're selling the euro, so if you get in and you say, I'm going to sell here on the euro USD, that means you're selling euro and buying USD. So what that is basically meaning is if you're buying euro USD, you're believing that euro is going to become stronger than the USD. So the chart is going to go up. So if you're buying euro USD, it is going up. If you're selling Euro USD, the chart will be going down. You're believing that the euro is going to become weaker than the USD, so the euro will go down. So you're always trading one currency against another. Here's an example. So it's hard to see, but if we got into this at the top right there of this chart, and we press sell, we're believing that the euro is going to become weaker, so the chart will go down. All right, we're going to jump straight into bid ask spread. The bid is the highest price a buyer is willing to pay for an asset. So if you're selling, this is the price you'll get. The ask is the lowest price a seller is willing to accept. If you're buying, this is the price you'll pay. Now, I don't usually use bid and ask. Some people like to use it. I don't. I just press buy or sell. It's basically the same thing. So if you press ask on your chart, you're basically buying. If you press bid, you're basically selling. The spread is the difference between the bid and the ask price. So spread is really important to know. You might not really need to know the bid and ask. You can just press buy or sell. I don't use it too much. I'm not too familiar with it because I don't really find it necessarily useful. So I use the spread. So we'll talk about the spread. The spread is the difference between the bid and the ask price. So this is how brokers make their money. Now, what is a broker? A broker is a middleman between you buying and selling an asset. So whenever I press buy or sell to get into a trade, the broker takes your money and actually buys that for you. So the spread is the difference that they make. Um, think of it like taxes almost. Like you're paying the broker what they owe, and it's just a little bit. It's nothing too crazy, but the spread does move, so you constantly need to know in forex what size the spread is. Leverage and margin. Leverage allows you to control a larger position with a smaller amount of money. It's like a loan from your broker to increase your buying power. So, for example, if you have $100 and your leverage is 1 to 100, you can trade up to $10,000 worth of leverage in a trade. So that's a 1 to 100. Margin is the amount of money you need your account to open and maintain a leveraged trade. For example, if you're using a 1 to 100 leverage, just like we just talked about, the required margin for a $10,000 trade is $100. So if your trade ends up becoming more than $10,000, you could get this thing called margin called, which means it will automatically pull you out of position. So you always want to make sure you have enough money in your account to have enough margin for your account. Now, these things are very confusing, and we could go in a lot more depth into the spread, a lot more depth into brokers, a lot more in depth into leverage and margin. But like I said, this is very basics. So if there's stuff that you're still confused about, you don't really have a good understanding, pop a question in. I would love to answer it. Or these are some areas and some things you can Google. I would ask you to avoid Googling different strategies that will get you more confused, but you can Google or chat GPT, what is leverage? What is margin? What is ask? What is spread, until you have a good understanding what those things are. Leverage or margin. Think of leverage as borrowing a car, the full trade size, and margin as the deposit you leave to borrow it. If the value of the car drops too much, your trade loses. The dealer or the broker takes it back, which is a margin call, so you lose money. Excuse me. Brokers and platforms. A broker is a middleman that connects you to the market. They execute your buy and sell orders. Some brokers also provide tools, charts, and leverage. Think of them as your access point to the trading world. A platform is a software you use to place trades and analyze the market. Examples include MetaTrader 4, MetaTrader 5, or CTrader. It's like the dashboard where you do all your trading. So, for example, I use TradingView, which is what you see in our examples. So, that is the platform. I'll connect my broker to that platform. And so, when I press buy or sell, that order will go to the broker and they will execute it. Here's some key terminology. Pips is the smallest price movement in Forex. So if the Euro USD moves from 1.1 to 1.1005, that has gone up 5 pips. Lots is the trade size. So this is for Forex in particular. I trade futures, but this is Forex that we're really talking about and highlighting today because that's where a lot of people start. Lots is trade size. So one standard lot is 100,000 units. The bigger the lot equals the bigger potential profit or loss. So you want to try to keep your lot sizes manageable. You don't want to go too big too soon. A stop loss is a set price where your trade will automatically close to limit your loss. So if the price ends up going to a certain level that you don't want it to go to and you're losing money, it'll just take you out of the trade at that level. For a take profit or a TP, a set price it's a set price where your trade will automatically close to lock in profit. So it's, say you get into a trade and it goes up in your favor, and you're making money, you can set a level, which is a take profit, where it will pull you out and you get to keep the money. Um, a buy is going long. You think price will go up, so you buy now and sell later at a higher price. Selling is going short. Short and long are just other terminologies for it. So if you say I'm going long, that means I'm in buys. If I say I'm going short, I'm in sells. You think if you're in a sell or you're going short, you think price will go down, so you'll sell and buy back later at a lower price. Um, to get out of the trade. Here's some examples. So the lots is the yellow circle there. That's how much position you're wanting to get in the trade, the higher the number, the more money you're risking. So let's say we're getting into this trade here. So if you see that white, it's really small white dotted line there on the chart. Let's say we get in there and the red line is where we want to set our stop loss. We're saying that when we set our stop loss there, that if price goes below the red line, we want to be out of the trade. We're happy to lose that money. If it goes up to the green line, that means we want to get out. We made money there. We're happy to get out there. If it continues to run up, it is what it is, but we want to just go ahead and take the money that we have where that green line is. So if you see there on the bottom left, I put in two different uh, orders examples that you could do. So you could press sell, and then you could take profit, tick stop loss, put in the uh, where you want those stop losses and take profits to be, and then press sell, or you could press buy, market, and then lots, and then put your stop loss, take profit in, and then press buy. Key terminology. So, market order means you're executing immediately at where the price currently is. That's when you want to be in quickly. So, if we go back to the price, if you look there on the bottom left or middle left there, you see how it says sell. It's in red, and then underneath it there's market. Right there, that's a market order. So that means we're going to get in right where that white line is. We're going to get in immediately. Now, if we do a limit order, so a limit order executes only at your set price. So, for example, we could say we want to get into buys here. So we'll click buy. And then if you look there above the yellow circle, there's market limit, stop limit. We'll click limit, and then we'll put the lot size in, and then we'll put our stop loss and take profit and click it. And basically where limit is we'll put it, let's say we'll put our limit order on the red line. So we're saying once the price gets to the red line, we want to buy. So that is basically saying I want to get in once price gets to this level, and it'll automatically put you in. That's what a limit order does. A stop order triggers a trade once price hits a certain level, then becomes a market order. This is often used for setting stop losses. We're not going to go into that too much. I don't use these too much. But if you need more help with that, feel free to put a question in the chat in our Discord. All right, reading a chart. Here we go. So these little bars, the red and green bars, are called candles. If it's red, if it's a red candle, that means price is going down. If it's a green candle, that means price is moving up. So if we look there, when price is moving down, that means it's closed at that bottom level. So where you see that close, I pointed it there, that's a close, and it opened at that top level. If it's a red candle, it opens at the top. If it's a red candle, that means it's closed at the bottom. If it's a green candle, it's opened at the bottom and it's closed at the top. That's your close. Now the rectangle part of your candle is called a body, and the little lines above and below are called wicks. That means price has gone up to that level and it just shows you where price has moved within that candle, but hasn't closed higher or lower. That's just showing the wicks of the candle. Right above, you'll see different time frames. You have a 1 minute, 2 minute, 3 minute, 4 minute, 5 minute. If your chart doesn't have those, you can customize it and just click on a little star and add those to your chart. But those are just different time frames there. Now, each candle right now, since we're in the 5 minute time frame, each candle represents 5 minutes of price movement. If we were to go to the daily time frame, every candle would represent 1 day of price movement, and so on for each time frame. Now, for a downtrend, uptrend, there's different types of market structure or market trends. So we have a downtrend. So that's when price is moving downwards. If you look, it's making a higher high or a higher low and a lower low, a higher low and a lower low, a higher low and a lower low. So it's moving in a downward position. If you notice, price never moves straight down; it moves in almost waves. And then if you look at consolidation in the yellow, price is moving within two areas and just bouncing off those two areas. That's called consolidation, or it's ranging. If we look at this uptrend, once again, it doesn't just shoot up. It goes up, pulls back, goes up, pulls back, goes up, pulls back. That's an uptrend. Risk management. Whenever you're trading, you never want to risk more than 1 to 2%. Make sure that you keep a solid stop loss with the amount of money you're willing to risk or lose. And make sure your position sizing isn't too large. Keep a, a modest, position size to ensure that you're not over risking. All right, so now we're going to jump into our strategy. We're coming to the end of our course. This is, like I said, very basic, and we might go ahead and take some of these areas and dissect them a bit more in future videos. But this is just to give you an overall rough crash course. Think of it as an intensive of just an overall view of the market. So here's a simple strategy that we can use. Now, here's some rules. We need to find an AOI, which is an area of interest. I'll explain that in a minute. You need to wait for a candle closure break and retest, and we're going to be targeting a 1 to 3. Here's a quick example. So rule number 1 is finding an area of interest. So for us, an area of interest would be that top rectangle and that bottom rectangle. Why? Because these are what we call support and resistance. You got to think of resistance as like a ceiling. So whenever price comes up to it, it struggles to break through. It kind of hits it and bounces down. Whenever you think of support, it's like a floor. It goes down to it and bounces up. And so these are areas of interest for us because price tends to react to these areas. Now, if price ends up breaking through a floor or ceiling and ends up coming right back in, those are what we call fake outs. But if we look here, we have a strong resistance and strong support. So we found our area of interest. We're going to wait for a break and a retest. So number 1's done. Now we're going to look for a break and retest. If we look here, it has broken our AOI. So we have the break, and it's not a break unless the candle body closes. This is so important. In most strategies, you need to have a candle closure. If it just wicks above, that means it could continue back down. So if you notice, a candle closure is when the body closes above. So if you look at the break candle where it's pointing at the break, that's the candle closure there, that green candle. So we got the candle closure. Now we're waiting for a retest. The price came right back into our area of interest. So it closed above, came right back in, and we see that strong wick. Now if that is telling me that the price moved down all the way down there, but it struggled to close below, which tells me buyers came back in. Buyers are saying, hold up, you can no longer come back below this area. You have to continue to be pushed back up. And then we have this engulfing candle. So we get the break, we get the retest, and then we get a large engulfing candle, which tells me I like to think of engulfing candles as like it's eating all the other candles. It's so big that it ate up all those other candles. So since that candle closed as an engulfing candle, this is telling me there's a high probability that this trade is going to continue up. Why? We broke above an AOI. It didn't. Usually in this area, price would like to go down. It will bounce, but since it didn't bounce, there's a chance that price will want to continue up. Now, this AOI, this resistance has become a floor, a floor. So it is now, it is isn't it is now support. And so there's now protection. There's almost like a cushion for us to be able to protect our stop loss. So we're going to get into this trade. So there we go. We're in now. I've placed a trade. We went buy, market ordered it. We're trading one lot, I think, yeah, we'll say one lot, even though I don't think it's one lot. We'll say one lot, just so it doesn't get confusing. And we're going to put our stop loss right under our AOI. Now, we could put it underneath the wick there, that large wick, but we're going to go ahead and trust that big engulfing candle that momentum is going to continue to the upside. As you can see, it played out, and we have a winning trade. Now, there's some things that I need you to understand before you go out and start practicing this. Here's some common mistakes. Is we need to keep it simple, and it feels very simple. And you're probably thinking, I can do this. This is not a problem. Let me just say this. This is where a lot of traders get it wrong. This is a common mistake. Is they think, oh, it's simple. I can just do this. I can put a lot of money in and just go straight into trading. Can I encourage you? Even though it's simple, doesn't mean it's easy. We can easily build these beliefs in our minds going, well, since this is simple, I can do this right now. And yes, you might feel confident and feel like you can, do this and maybe start off and do really well. Or maybe have beginner's luck. But that's the problem is you might get beginner's luck, do really well, and start and then end up losing because you haven't mastered it yet. Can I encourage you, master it? find the nuances of the break and retest strategy. There are nuances. There might be some other confluences we call confluences, which is things that you can add to confirm that this is a good trade to get into, and master it. Learn how price reacts to certain levels. Learn what levels are the best levels. Like, don't jump in head first too quick. Practice, practice, practice. Spend at least, if I could encourage you, spend 3 months at least practicing this strategy. I just want to remind you, just to reaffirm this, that statistics say, and I don't think this is 100% accurate, but you'll hear a lot of traders say this. Statistics say that only 10% of people are actually profitable traders, and 90% of people lose money over time. So I want to encourage you, with this statistic in mind, don't think that you are like some person that is exempt from the rule. No, there's a high probability you will not be successful. There's a high probability. But I am confident you can do it if you put the work in, you practice, and you master it. Okay. If you have any questions, feel free to put it in the chat. Like I said, this was a very, very, very quick lesson. And so I want to encourage you. We'll jump into these things a bit more, ask questions, be inquisitive, and hopefully over time, we'll be able to build a community of successful traders that are thriving and learning and growing and sharpening each other. Well, appreciate you guys. Feel free to follow me on my Instagram, follow me on my YouTube. We will go live and trade live, and we'll continue to put out content that will hopefully help you become the best trader you can be. God bless, and we'll see you soon.